How's it going, everyone, and welcome back to the Prorsum Trading Group YouTube channel. My name is Marcus, and in today's video we'll be breaking down our gold trade that we sent out to our trading team on the 4th of March and which got executed from the 10th of March from the 2887 region, riding price all the way up to the milestone mark of 3,000. So let's get straight into it.
As we can see here, we've got our gold trade just literally on the week we was looking to execute our main buy position. Now I just want to talk of the leading up to the buy, but first, before we get started into any technicals, we always think it is best to start off by understanding the global risk environment that we are currently in, especially because we are trading a commodity. Very, very important to have a clear understanding of the global risk environment. And as we know, we currently at a rapid rate, we can see trade wars escalating. Tariffs are being applied left, right and centre from the US, and now in retaliation we are starting to see some of these countries apply higher tariffs back to the US. And with the US stock market taking a huge crash over the past 2 weeks, with Tesla cutting 50% since all-time highs, we've got Apple dropping 12% since within a month's period, we can now sort of understand that all of the money will be flowing into a commodity such as gold, being it's such a safe haven of an investment. So now we understand our global risk environment, so we are looking for buys on the commodity sector. That gives us a clean understanding of how much of a pullback we can expect technically, and for us to be looking into just swing long-term buys. And if we are taking any sell positions, we are either using them to hedge profits from our previous buys, or we are looking just to ride them as small pullback buys. So let's get started in regards to a technical aspect. Now, I think it's very clean to and important to understand, we want to make sure we've got higher time frame confirmation in trend along all time frames. So one thing we started off by doing was applying our trend lines to our trades, and if we look on the daily, we can see we've got a nice uptrend here and we've got a nice uptrend flowing here. So these are where our two trend lines come from, and we want to make it very important when drawing our trend lines on the higher time frames that we are not looking at cutting any candle bodies. It's okay to for us to cut through the wicks, because as we go down the trend line, we'll be readjusting to suit our needs, but we are not wanting to cut any of the candlesticks. So this is how we got our trend line, so from a bias. And now this gives us very clean understanding that when we broke into the trend line on Friday the 28th, this was just a clean indication that this could now be a fake out, and that is why we draw the trend line like that. So now that we've got a clean fake out happening and we've seen price close back into the trend, it's still a clean understanding that we are still very, very bullish. So for the previous week, if we look to the left, we can see price continuing a double top, which then pushed us into a reversal state, just for the short term, creating a series of lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and then which rejected us then onto our daily level, which then formed as sort of a nice double bottom we can look into here. So after seeing a nice double bottom on the daily and price closing back into the trend line, we can now look for more technical confirmations for another buy entry. Now, when looking at the trend line structure, one of the first things we always cover when people come into our academy, and that is understanding the phases that play out when a trend is forming. So what we have is we have what's known as phase 1 being an impulsive phase, phase 2 being a retracement phase, and phase 3 being a continuation phase. So if we see here, and we always want to be looking into the impulsive phase. So how do you know it's an impulsive phase? You know it's an impulsive phase because it breaks the trend line structure of the previous trend. So if we have a look, we see bearish being formation being brought here, and price straight away started to break this trend line structure with these huge bullish engulfing candles. So if we was to look left, we now know this here is our impulsive move. So now we always want to be looking at executing phase 3, which is the continuation move. So we use the impulsive move to find the retracement. So we start off by applying the fib retracement tool, by applying it swing highs to swing lows, and then we want to be looking at the best level for our confirmations. If you're in the academy, you guys know that our best levels we look for are the 38.2 and the 61.8, and the 50 is just the indication. So what we are going to head and go and do is let's have a look at during a zone out from our fib level, so then we can get a clean indication of what other confirmation we'll have if price comes down to this level here. So as we can see, if price was to just make it so it's very visible for everyone to see, if price was to drop into this level here, we can see we've got a nice trend line touch, the 38.2 fib confirmation and structure to the left. But the reason why we've got this zone here drawn out is because it's a good intraday key level. And as we know, price has been making fake outs throughout, as we come close to the trend line, price has been faking out. So what we want to keep in mind is price could potentially come into this level and now start to fake out like we saw previously and then continue. So we want to keep all of that in mind. So our buy position we would be looking at taking would be looking at executing a buy. 2 seconds, let me draw out the fib so we know exactly where we'll be going to. Perfect. So there we've got our fib take profit levels, if anyone was wondering what the 2 levels were up there. So now we've got price can potentially make the higher low. On the higher low, we would get a trend line touch, 38.2 structure to the left, and we can also have the global risk environment in our favor. And I think that's very, very important to add to the trade, that we've got fundamentals and global risk environments in our favor. It's not just technicals for the entry, we've got the reports backing it as well. Now, also one thing to mention and one good thing to highlight is the consolidation phase we saw play out here, and I believe this was from 2920s down to 2900s. This consolidation phase, we can see it was the lead up to the NFP report on a Friday. So for any sort of more advanced traders and more clued up from a fundamental side of things, you will know and understand that the NFP report is brings through one of the most volumes when the report is dropped. So it brings through the most volume. And this is the whole reason being is it's a very high impact in news. You've got unemployment rate that drops at the same time, and it sort of gives you an overall strength of the economy. So that being said, what we can see is if this news report came through and comes through, what we can tend to see is price then slip in and then start to come back up, because don't forget there's a lot of buy liquidity probably sat around the bottom of this consolidation zone throughout a whole week of just buys, and people price just kept coming back to the entries, coming back to their entry. So this is how we captured the buy. Now if we go ahead and look at how price action actually occurred into this trade, here we go. We can see price very solidly coming into our favor, and look at what we mentioned earlier. Price made a fake out here, so we should expect another potential fake out. And if we was to fake out, where is the next potential point where we could fake out to? And this is the reason why we put that intraday key level on here when executing the trade. And the good thing to understand is it's very good to have as a good stop loss placement as well. Now what we want to be looking at doing is saying, okay, where should we look at taking partials out of the market, and when should we be looking at putting stop loss to entry and removing all risk. Me personally, I like to, as soon as I take partials, I like to remove all risk from the trade, because then I can apply the risk onto a compound trade to then maximize more profits coming through. So that being said, one thing I'd like to do is take a small amount of partials. Now on my first partial take, I'll always aim for around 20% of the position. So I'd look to exit around 20% at take profit 1. So I'd be looking at take profit 1 to be the top of the consolidation zone of the previous week, which was here, and that sits at around 29.30. And then take profit 2 will always be at the all-time high section, currently here. The reason being is if we see a strong closure in this area, there would be a strong potential of a triple top forming, which is a solid reversal pattern. And then if we have any peace talks coming out in our way, we could then see a nice drop down. But until then, we've know the global risk environment. There's no peace talks being spoken about. We've still got tensions with Russia, Ukraine. There's been no ceasefire on the Gaza Strip. We've got trade wars going off left, right and centre. We've got the US stock market crash. So this all is leading to gold's return back to the all-time highs, and we've got a strong psychological number that we're pinpointing of 3,000. So, but we would be looking at taking more partials at around all-time highs. But one thing I want to be looking at doing is once price breaks out of this consolidation zone, and if we see a strong closure, I want to see a pullback, and then we can look at entering a compound position to ride back up to the top to maximize on our profits. So our compound position, I'd want to be sat at this area to be safe, riding it all the way up, and then having price, like I said, stop loss below just these lows here, and then price back up to all-time highs as well. So now let's see how this one would have pulled through. And just like that, if we have a look at the risk to reward ratios of both trades, we can see here we've got a 1 to 7.6. So I'll just say a 1 to 7. And then if we say a 1 to 3 as well. So this is how we could have gained over 10% throughout these trades. And as you guys saw from the start of the video, this trade was all given to our Academy members on the 4th of March. So if we have a look here, on the 4th of March, we sent that update letting everyone know that our price was active. Our scenario 3 was active. And every Sunday, what we do with our Academy members is we do a Sunday market breakdown where we do an in-depth technical analysis on gold and forex pairs, and we also then do a strong fundamental analysis, understanding what fundamental reports are going to be dropping. Is there any new talks of ceasefire, peace talks? If so, how would this potentially affect gold? And we break down everything to look out for in the market, and we come up with 3 scenarios for every pair that could play out. So I just thought I'd end it here, and I just would like to say a big thank you for everyone for watching this video. If you'd like to see more content like this and you'd like to keep up to date with the markets with Prawsome, don't forget to like and subscribe to our YouTube channel. Once again, a big thank you, and we hope this video was very helpful for anyone understanding a technical side of trading. Thank you very much, and we'll see you soon.